Gold hits a new record high as the US 10-year yield falls to its lowest point this year. China holds the Yuan strongly amid depreciation pressure, and New Zealand's job market loosens enough to greenlight the Reserve Bank of New Zealand to cut 50 basis points in a couple of weeks' time. That's coming up in our 5 Things in 5 Minutes on Thursday, February the 6th. And then, in today's bonus deep dive interview, ANZ Senior Commodities Strategist Daniel Hynes explains what's behind the moves seen in gold and oil prices in recent days.
Things are changing quite quickly, and we could see curveballs thrown at commodity markets in weeks or months to come. So you do have to keep a close eye on it.
But first, in 5 and 5 with ANZ, global markets are mixed this morning amid ongoing ructions in global trade. Although gold rose to a fresh record high of over $2,900 an ounce overnight, helped by a fall in the US 10-year yield of 9 basis points to 4.41%, its lowest level this year. That came after a survey of US services activity showed new orders fell to their lowest level since June. Amid the to and fro between US and China, the People's Bank of China yesterday set its weekly fix for the yuan at 7.1693 per US dollar, 5 basis points stronger than last week. ANZ Head of Asia Research, Koon Go, says the move is part of a measured response from China to US tariffs.
In terms of the currency, they have no desire to weaken it at this stage. Partly, I believe that there's still hope that some kind of agreement can still be reached for the tariff to be unwound, just like the deal that Mexico and Canada managed to strike with the US. So for now, the Chinese authorities are not retaliating firm way. They are being more measured in their approach.
As of 4 a.m. Sydney Melbourne time, the US dollar index was down 0.4%, the S&P 500 was up 0.2%, while the Aussie was up 0.6% at 62.90 US cents, and the Kiwi rose 0.9% to 56.93 US cents. Number 2. Koon says the move signals China wants to achieve a resolution to the tariff war.
The retaliation by China to the tariffs is that they have increased tariffs, but only on around 14 billion US dollars worth of imports, which is only 8.5% of their total imports from the US. And those tariffs don't take effect until the 10th of February next week. So obviously that gives several days for talks and hopefully some kind of agreement to be reached. And given how sensitive the US is to any large depreciation by China, the fact that they have decided to hold a fix steady as well today is probably no coincidence. I think they are showing probably good faith to the US. They don't want to overreact.
Number 3. New Zealand's unemployment rate lifted from 4.8% to 5.1% in the fourth quarter last year, in line with ANZ Research and the Reserve Bank of New Zealand's expectations. Employment contracted by 0.1% in the quarter, which was slightly less than expected. ANZ economist Henry Russell says underutilisation and underemployment rose alongside the jobless rate.
These continue to suggest that the New Zealand labour market is operating with a significant degree of spare capacity, and that's flowing through to lower wage growth, and wages are no longer a threat to domestic inflation. But given what we saw yesterday was in line with expectations, it does not stand in the way of the Reserve Bank delivering another 50 basis point cut when it meets in February.
Number 4. Henry says the numbers are a reflection of where the economy has been rather than where it's going. He says a recovery could be seen later this year.
The labour market does tend to lag the broader economic cycle, and so in that sense there is still likely to be a little bit of weakness left to come, and we do expect the unemployment rate will continue to rise in the first half of this year. But more encouragingly, the contraction in employment was slightly less than what we had anticipated, and taken with the recent monthly gains in filled jobs we've seen over the past few months, it does point to a stabilisation in labour demand that is likely to pave the way for a recovery in the labour market later into 2025.
Number 5. South Korea's inflation rate was 2.2% in January, at the top end of expectations and above the Bank of Korea's 2% target. ANZ economist Crystal Tan says the upside surprise was mainly due to global energy prices and local currency weakness.
The Lunar New Year festivities likely also contributed to price pressures. Core inflation did pick up, but only slightly, to 1.9% year-on-year. Thing is, barring a renewed spike in global energy prices, inflation in South Korea is unlikely to deviate significantly from the central bank's 2% target going forward. There will be some upward pressure from currency weakness, but this should be counterbalanced by subdued domestic demand. So we do think that growth is going to be the priority for the Bank of Korea. We continue to expect it to deliver a 25 basis point rate cut at its meeting later this month.
Crystal Tan there. Now, in today's deep dive interview, ANZ Senior Commodities Analyst Daniel Hynes explains how uncertainty and volatility created by on-again, off-again trade war announcements and concerns about global growth are affecting gold and oil prices. Here he is talking about the record gold price hit this week.
Initially, we've seen investor demand really be behind the move. Now, the reasons for the increased interest from investors, I think, ultimately has been the uncertain economic backdrop that we're now entering into. While the tariffs themselves present issues around trade flows and the like, I think the impact is still unknown on a sort of a global economic scale. And certainly that uncertainty around the economic backdrop is ultimately one of gold's favoured drivers. In periods where we do see global economic growth suffer, gold's status as a bit of a defensive asset, a haven asset, does come into play. So that's really what's been driving it. I think ultimately, though, there's some other factors at play. Certainly the ongoing sort of de-dollarization theme, I think, is pertinent, particularly with Trump now driving this America First strategy. I think countries like China looking to try and diversify away from that dollar.
So does that mean that once we get more certainty on these tariffs, the gold price could fall back again?
Well, I think the jury's still out as to what the overriding sort of impact of these current policies and the longevity of them, I suppose, what that will mean economically over the sort of medium to longer term. Certainly, if things are removed quickly, there's probably going to be a little bit of a pullback, but I still think there'll be some level of uncertainty around President Trump's foreign and trade policies, this America First sort of policy, which will certainly impact the global economy. So some demand may dissipate because of those tariffs potentially being removed, but I think ultimately there's still a high level of uncertainty within the global economy to sustain a large part of the build that we've seen so far in gold.
Just turning to oil, what's really driving it? Is it concerns about China's economic outlook, about the tariff news, or is it broader concerns about the global economic outlook?
I think some of the sort of day-to-day move have been driven more by, I suppose, the actual impact of, say, a 10% tariff on Canadian oil. So that's clearly going to put some upward pressure on US oil prices, like the WTI contract, just purely due to the fact they import a large amount from Canada. But overriding that, I suppose, is what a trade war would mean for global growth again, and oil is pretty closely linked to global economic activity. So I think that uncertainty around what it means for economic growth is ultimately the driver for oil prices over the sort of the medium term.
So have your forecasts changed at all, given what we've seen in recent weeks?
Look, the metals and energy policies that Trump has implemented in his initial days in the White House have come pretty close to our sort of initial expectations. So I think for the moment we're happy with where we sit. Obviously, things are changing quite quickly and we could see some curveballs thrown at commodity markets in weeks or months to come. So you do have to keep a close eye on it. But I think our expectations of slightly higher oil prices under Trump seem to be sort of playing out at the moment, and certainly precious metal markets have been pretty strong beneficiaries of that. So for the moment, it's playing out as expected, but we don't deny there's some volatility ahead, I suppose, for commodity markets.
Daniel Hynes there. I'm Bernard Hickey. That was 5 and 5 with ANZ for Thursday, February the 6th. Catch you tomorrow with the Bank of England's rate decision, which ANZ Research expects will be a 25 basis point cut to 4.5%. This podcast contains general information only, not investment advice. You should obtain advice for your personal circumstances before making any investment decisions. Please view the podcast disclaimer available via your media player or email.